Hello students. Today we are going to learn chapter 5 of macroeconomics, that is government budget, part 1. So what are we going to learn in this session? First we'll understand the meaning and objectives of government budget as to what is the importance of government budget, why is it necessary. We will also study about the components of government budget, classification of receipt, which is capital and revenue receipts. We'll also study about classification of expenditure. Same way as we have receipts, we also have payments, that is expenditure. So which is again divided into capital expenditure and revenue expenditure. We would also talk about various deficit, that is budget, either surplus or deficit. And again, budget deficit is divided into revenue deficit, fiscal deficit, and primary deficit. So we'll study that what is the meaning of these deficits and what are the implications. So first let's understand what is meaning of government budget. A government budget is an annual statement of estimated receipts and estimated expenditure of the government during a fiscal year. It is very simple that how much government have received or earned, that is revenues, and how much they are going to spend during the particular financial or a fiscal year, which is taken from 1st April to 31st of March. Now, what are the objectives of government budget? The first objective is reallocation of resources. It means managed and proper distribution of all the resources which are available in the economy. So as private sector cannot provide all the goods and services, the government has to provide these goods. Many a times it happens that private sector does not produce those goods and commodities which are not profitable to them, because the main motive of the private sector is to earn profit. And if those goods are of necessity goods, now who is going to produce that? Because if it's a necessity product, it would be required by all the people. So for the welfare purpose and for the service purpose, the government will have to produce this kind of goods and services. So they are trying to manage and properly distribute all the resources. The second objective is to reduce inequalities in income and wealth. Now through budget, government tries to reduce the gap between the rich and the poor. Now how are we going to reduce this gap? Of course, by charging taxes. Now those tax could be either direct tax, which is income tax, wealth tax, or it could be indirect tax, that is sales tax, excise duty, custom duty, GST. So by imposing direct or indirect taxes, we can bridge the gap between the rich and the poor. So over here, more taxes are being taken from the rich, and that money is utilized for the welfare of the economy. The third objective is to achieve economic stability. Now see, there might be inflation or depression, that is there. Sometimes the economy faces booming period or a recession or fluctuations. So every economy faces either inflation or depression in its economy. And inflation is the situation where the prices are rising continuously. So continuous rise in the general price level is known as inflation. And continuous fall in the price level or the general price level of the commodity is known as depression. So during depression, the government reduces the rate of tax and borrowings and increases the public expenditure. And during inflation, government increases the rate of tax and borrowings and decreases public expenditure. So they can have stability in the economy. So neither too much of inflation nor too much of depression is good for the economy. There has to be a balance, there has to be a stability. So government budget's main objective is to achieve economic stability. The another objective of government budget is management of public enterprises. There are large number of public enterprises which are established and managed for social welfare of the public. As I just said, that there are many goods which might not be produced by private sector because they feel if they are not able to earn more profit by production of those goods, then who are to produce these goods? So it is the government who would produce such commodities for the welfare of the public. Another objective is to achieve economic growth. Now that would depend upon the rate of savings and investment. So government would always encourage more of a saving and more of investment. And next objective is to reduce regional disparity. Now, how can we reduce the regional disparity? Not only through taxation and expenditure policy, but by also starting up the companies or a public sector into the backward areas or remote areas, so that growth and development or growth in terms of infrastructure can be taken place in those backward regions. Now, when we talk about the components of government budget, there are two main components, revenue budget and capital budget. Now, under revenue and capital, if we talk about components of budget can also be categorized on the basis of receipts and expenditure. So we can have budget receipt and budget expenditure. So let's talk about budget receipt first. Budget receipts refer to estimated money receipts of the government from all the sources during a given fiscal year. Receipt means receiving and expenditure means the payment. So when we talk about budget receipt, every government or every economy would have their planned receipts and payment. So this revenue receipts can be subdivided into tax revenue and non-tax revenue. So where are we going to receive these revenue from? Either through tax sources or through non-tax. When we talk about capital receipts, it can be further subdivided. That is, which means that we can have capital receipts either by borrowing or by recovery of loan or any other receipts. So first, let's understand that what is capital receipt. Capital receipts refers to those receipts of the government which tend to create liability or it causes reduction in its asset. All the capital receipts are broadly classified into three categories. First one, recovery of loan. These are the capital receipts because they reduce financial assets of the government. And borrowings means the fund which are raised by the government from the borrowing are treated as capital receipt, and such receipts create liability. Now, when we talk about other receipts, fund raised through disinvestment are included in this category. So by this, government assets are reduced. Now, when we say disinvestment, it means when the government stops investing into certain public sector companies or PSEs and they transfer these to the private companies. So in this case, the government assets are reduced because now no longer the government would be interested to invest into such public sector companies. Now, when we talk about revenue receipts, any receipt which do not either create a liability or lead to reduction in asset, which means it is not creating any liability, neither any reduction in asset, then it is called as revenue receipt. And as I said that we have the sources of revenue receipts are through tax and non-tax revenue. Now, when we talk about tax revenue, we are referring to direct or indirect tax. Direct tax, we can take the example as income tax, wealth tax. An example for indirect tax, we can take it as an excise duty, GST, sales tax. These are the sources of tax revenue, either through direct or indirect tax. When we talk about non-tax revenue, which means these are the receipts or revenues or earnings which government have received not through taxation. So what are those? It could be the interest which government is receiving, or the profit or dividend, or fees and fines like license fees or when any company started, they need a license or registration, or any fines which are imposed on the public or any person or any organization. Those fees and fines are also part of non-tax revenue. Gifts and grants, and all the revenues which are earned from PSEs. These are also part of non-tax revenue. Now, how to classify a tax as a direct tax or indirect tax? A tax is a direct tax if its burden cannot be shifted. For example, income tax is a burden tax as its impact and incidence is on the same person. For example, if I am the person who's supposed to pay the income tax, the burden is on me. I cannot transfer that burden to somebody else. So that is my direct tax, that is income tax. Now, a tax is an indirect tax if its burden can be shifted. For example, sales tax is an indirect tax as its impact and incidence is on different persons. Like, let's say, for example, if you're a manufacturer and you're imposed a sales tax, he is going to transfer that burden to the people who are going to buy it. The other form of taxations are corporate tax, value added tax. Now we have GST, of course, no more VAT. So service tax, excise duty, wealth tax, and sales tax. Now, how to classify a receipt as a revenue receipt or capital receipt? So if you are receiving earnings, you will have to categorize and find out whether it is a revenue receipt or a capital receipt. So a receipt is a capital receipt if it creates a liability or reduces an asset. So if any liability is created or if it is reducing the asset of the government, then it is termed as a capital receipt. A receipt is a revenue receipt if it neither creates a liability nor reduces any asset. So this was all about the capital or the budget receipts and expenditure. Thank you.